Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. Well, the June 2020 financial year is just finished up, and we thought it'd be worthwhile just looking back at the performance of financial markets over the last 12 months, where we've seen the returns being generated, and whether or not we're likely to see sort of a similar profile as we head into the second half of this year into 2021. The first of the charts here just shows the performance of the ASX 200, and you can see here that the broader market return on the far left-hand side was down roughly around about sort of 8% over the course of 2020, and certainly one of the few years over the last couple of years that we've actually had a negative return. Driving that performance, by and large, we saw negative returns, particularly out of the energy sector, which was down considerably on the weaker oil price and the demand for oil throughout the course of 2020, and a lot of that was driven over the last 6-month period where we saw significant lockdowns on a global basis. And more domestically, the decline in banking stocks over the last 12 months, again, driven by the COVID lockdown, demand for credit obviously falling away, and that obviously had a significant impact in certainly the growth outlook for financial stocks. And given the fact that they represent quite a significant proportion of our local share market, that obviously flowed through into the overall performance of the equity market. But when we look at some of the winners, and there've been really three key areas that we think have been sustained outperformers. Consumer staples, they've certainly benefited not only over the last 12 months, but we certainly saw quite a significant pickup in sales on the back of the lockdown. People starting to hoard goods in order for them to be able to survive periods of lockdown. So that had a bump in sales, particularly on consumer staples such as Woolworths and Coles and the like. So that obviously benefited, as I said, that part of the market. And then both the healthcare and IT sectors have continued to remain very robust in terms of their performance over the last 12-month period. And they've been positions that, as you know, we've held in our portfolios for an extended period. We continue to see those two parts of the market continue to benefit from not only changing consumer behaviour as it relates to IT and the need for increased data storage and the like, but equally on the healthcare side of things, just the quality of the businesses we have in the local market, CSL, ResMed, just to name a couple there that have benefited, as I said, from what we've seen not only domestically as it relates to the demand for their products and their services, but equally on a global basis when we're thinking about ResMed and supplying of ventilators in the US, for example. So from an Australian point of view, as I said, it's been a mixed bag. We continue to expect that'll be the case. We would like to see a more broader distribution of performance coming from other parts of the market, and again we think that there continue to be some opportunities, particularly in the materials and industrial space. But certainly as we sit here today, we think that as we head into reporting season, it's going to be a challenging period for parts of the market, particularly given, as I said, that the likelihood of growth and slowness in growth is going to continue for some time to come through the second half of this year. The next chart just gives you a snapshot for global financial markets and looking broadly across multiple asset classes. And you can see really two component parts that we would draw upon. Firstly, on the left-hand side, cash, Australian fixed income, global fixed income have all delivered positive returns, particularly thinking about it in regards to the fixed income defensive part of the market has delivered that, as I said, that positive outcome. So when thinking about a broad-based diversified portfolio, the heavy lifting has certainly been done by those defensive sectors over the last 12 months. And from our perspective, that's a really important element as to why you have diversity in terms of the underlying asset profile within a portfolio. It enables you to be able to, as I said, deliver that investment return when markets have been volatile, certainly equity markets, and be able to, as I said, protect some of that downside performance in a portfolio with the utilisation of defensive asset classes such as fixed income in more volatile and more troubling times. Equally, we've seen global equities certainly over the last 12 months deliver a positive return. A couple of elements associated with that from our perspective. First and foremost, the diversity of underlying investments that you can get on a global basis. So think about it in the context that no one sector makes up a significant proportion of global financial markets. It's a benefit because you can get that spread of investments across multiple industry segments without having a significant exposure to one particular part of the market like we do here, for example, as it relates to banks. And secondly, the performance of the Australian dollar. So the Australian dollar's really had two parts to it over the the last 12-month period, and certainly the fact that the Australian dollar has fallen against the US dollar primarily, but also against other currencies over that 12-month period has provided a benefit to investors in offshore markets, so they repatriate those earnings in offshore earnings into Australian dollars, and that's assisted the performance over that 12-month period. Clearly, the period between January and June of this year, we've seen obviously all equity markets really struggle. Global equity markets no different in that context. And then we saw some significant declines, particularly as it related to the property listed property space, whether it be in domestic A-REITs, global REITs and the like. That part of the market has really struggled. And again, no surprises there when you think about the context of what we've seen in a decline in economic activity, decline in manufacturing, clearly the commercial office space with people now working from home, that side of the market, shopping malls and the like have really struggled in terms of growth and obviously from an earnings perspective. And so that's been translated in regards to the performance of those sectors, particularly over the last 12 months. As we look forward, we continue to expect that those parts of the market are going to be challenged. We think infrastructure, certainly as a recovery starts to take hold through the second half into 2021, we think that that's going to be a benefit in the context of the performance, but certainly in the near term, it continues to remain challenged just simply on the basis that economic activity remains relatively constrained. But when looking at the performance, whether it be on a domestic sense in terms of individual sectors or on a global perspective, you can see that there have been few winners in terms of asset class performance through 2020. As we sit here today thinking about the next 6 months and certainly over the next 12, 18 months and the like, and as we work through what a new normal looks like, we do expect the financial markets are going to continue to remain challenged. Economic activity is still a fair way away from what it was pre-COVID, and we expect that now to probably be a lot longer in regards to, as I said, getting back to a more normal operating environment. But we think the normal going forward is going to look again quite different to what we saw pre-COVID. So that's going to have implications for financial markets. It's going to have implications for the speed of which economic recoveries occur, whether it be domestic or on a global basis, and ultimately in terms of the sectors and those sectors that we think are going to continue to be able to deliver, and those sectors that may be the winners out of what we're seeing over the next little while. As always, we'd love to hear from you, so please feel free to reach out to any one of our advisors, and we look forward to touching base again soon. Thanks, and bye for now.